China's economy has faced major disruptions through 2021 due to the ongoing China-U.S. trade war, COVID-19 restrictions, and power shortages. While the economy may continue to suffer from the ongoing trade war and possible COVID-19 resurgences, new issues are likely to rise to the forefront of economic problems in 2022. These include combating the real estate downturn and inflation, as well as bringing about common prosperity. However, risks are likely to be tightly controlled due to the upcoming 20th Party Congress in the second half of the year, as Xi Jinping is widely expected to notch a third term in office. Ongoing real estate downturn. China's real estate developers suffered through 2021 due to increased financial restrictions, which led some developers, most famously Evergrande, to default on some debt repayments. Commercial sales and real estate investment growth have slowed down. Debt among property developers will continue to pose a barrier to achieving financial health in this sector. The Economic Work Meeting laid out the need to promote the construction of affordable housing and adjust the commercial housing market to better meet buyers' housing needs. This industry represents a key investment channel for consumers, and falling home prices are quickly shored up by local government policies. At the same time, consumers often face challenges in purchasing new homes due to the higher prices, which the government attempts to address by encouraging the construction of affordable housing. Inflation. Producer price inflation created rising prices in 2021 without heavily impacting consumer price inflation. This was due to high commodity prices and transportation bottlenecks, combined with labor and energy shortages. Supply chain disruptions are likely to continue somewhat into 2022, eased by the second half of the year as interruptions due to COVID-19 and surging demand stabilize. In addition, China's power shortages due to emissions restrictions will be reset in 2022, and production plans are likely to be adjusted. Producers have begun to pass through higher costs to consumers, resulting in a slight rise in consumer price inflation. Somewhat increasing food prices have also resulted in higher CPI. Rising demand ahead of the Chinese New Year is expected to result in a higher CPI to some extent in January. In addition, inflation in the United States and the European Union is likely to be transmitted to China through rising import prices. Therefore, although CPI remains much lower than PPI, CPI is likely to rise in 2022. Common prosperity. Xi Jinping has continued to underscore the importance of common prosperity, which involves cultivating quality and more egalitarian economic development. Along with this, China ushered in a slew of regulations in 2021, some of which cracked down on monopolistic firms and their anti-consumer practices. Already, the campaign has induced wealthy individuals and firms to donate to charity in an attempt to reduce economic inequality ahead of further government regulations. The drive for common prosperity will continue to gain force through 2022, although how it will be translated into specific policies remains somewhat unpredictable. More regulations to control excessive and unfair economic gains and policies to reduce inequality may come into effect. Slowing growth. The Chinese government has prioritized economic stability for 2022. Han Wenshou, deputy director of the Office of the Central Committee of Finance and Economics, stated after the Central Economic Work Conference that officials must be cautious in introducing policies that have an economic tightening effect. The World Bank has set China's 2022 growth forecast to 5.1%, a much slower pace of growth than China averaged in previous decades. China is likely to shore up GDP by investing, once again, in fixed assets. Infrastructure investment will comprise a large part of this. The country will probably issue more special bonds in order to partly finance fiscal spending. Export-driven economy to consumption-driven economy. The Chinese economic miracle was fueled by the United States consumption debacle. The United States has almost extensively been consuming China's produce. China has been exporting to a lot of other nations as well. However, the United States single-handedly accounts for over a third of Chinese exports. The United States consumption has been enabled by loose interest rate policies implemented by the Fed. Zero interest rates led to a lot of money floating around. A huge chunk of this floating money ended up being spent on Chinese goods. After 8 years of zero interest rate policy, the rates are now set to rise. This is expected to cause a drastic drop in demand in the United States. As a result, Chinese exports will also suffer. Add to this the fact that the economy is already slowing down and we may have a deflationary scenario underway. China's big challenge is to sustain its economic prowess in a domestic economy. Instead of selling to other countries, Chinese businesses now have to sell to each other, if the miracle has to be sustained. Manufacturing and banking viability. The Chinese government's central planning has led to a lot of malinvestments. This is particularly true in the manufacturing sector. Since the money was loaned out by state banks, the banking system is also reeling under the effects of this problem. The government is currently managing these non-performing assets. However, these assets could cause mayhem in the Chinese banking sector. Also, a lot of money has been lent out to developers who have built ghost, uninhabited towns with it. This money is also unlikely to be recovered. The Chinese banking system could come under a lot of pressure as these NPAs become certain. The spillover effects of this downturn could be felt in the stock markets as well as across the world. Tax revenues and expenses. A falling GDP also means falling tax revenues for the Chinese government. This becomes a huge problem when one adds the fact that China is a communist country. A centralized economy is based on funds being disbursed from the center. Falling tax revenues and rising expenditures have created shortfalls that need to be filled by borrowing money. Given the debt trap that China may soon find itself in, borrowing is not really a viable option. China will have to figure out other ways to collect more tax, or else it may have to cut spending even further, causing the GDP to go into freefall. Regional imbalances, coastal to internal. The economic boom has led to widespread development all across China's coastal periphery. This is obvious given the fact that the Chinese growth story was fueled by exports. Now, since domestic consumption is the key factor, China will have to focus on its severely underdeveloped internal areas. Interior China is still a third-world country with low standards of living. This can be viewed as a challenge because sustaining high Chinese growth rates with such poor infrastructure will be difficult, to say the least. Also, it can be viewed as an opportunity since developing the internal areas will help give a fillip to the Chinese GDP for several years to come. Thus, there is enough fuel for the Chinese growth juggernaut to continue its run for another year or so.